I like diversification, so I have more than 30 investments that yield an average of just over 10%. But what if I had to choose just 3? Well then, diversification and consistent income weigh into that decision. Today, I'll reveal which 3 I choose and, more importantly, why. I have no plans to shrink 36 income investments down to 3, but this exercise is useful because it forces me to focus on what really matters when building a portfolio. Let's dive straight in with QQQI, which is currently yielding just over 13% and offers reasonably consistent monthly income. Payouts dipped slightly for the April 2025 tariff correction, but then recovered to new highs. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%. And if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. A covered call index fund is an easy choice if you're optimistic about the stock market and the continuation of the AI boom. The first question is S&P 500 or NASDAQ 100. I think either of those is good, but NASDAQ is slightly more aggressive, meaning higher return and more volatility. The second question is which fund. QQQI is young. It came out in early 2024, but it's the same strategy as SPYI, which goes back to 2022. You can get more performance history from QYLD, JEPQ, or QQQX. QQQI has easily outperformed QYLD and JEPQ since it was launched, and I'm assuming that will continue. QQQX and QQQI have been much closer in performance, but I expect QQQI to be more consistent with its tax efficiency. According to the recent tax documents from the funds, QQQX issued 60% return of capital and QQQI was above 90%. Remember, this is a tax treatment, not a return of investor principal, so it's a good thing. The tax benefits of QQQI are explored in more detail in this analysis by GP Sigma Analytics on Seeking Alpha. It also gives a good overview of the option strategy for that fund. I'll link to that article in the description, as well as a link for a free trial and a discount. I don't buy or sell any fund without first checking it on Seeking Alpha. The limitation of QQQI is the same as for all covered call index funds. If there's a major stock correction over a long period of time, the distributions are at risk of being reduced. The yield generated by selling calls is a function of the market value of the stocks in the index, not the income those individual stocks produce. Or to put it another way, the fate of your income is entirely driven by stocks, and they don't always go up. Fortunately, income investors have options to diversify beyond stocks. And you can learn more about the limitations of covered call ETFs in this recent interview with the NEOS co-founder, Garrett Paolella. The easiest way to diversify beyond stocks is to invest in credit, which means the various forms of lending, such as loans or corporate bonds. The beauty of credit is you don't need the value of something to increase. You just need the borrower to pay back in full. And even if they don't do that, there's often collateral that the lender can liquidate to recover their principal. Several options here, but I chose PBDC, which is currently yielding 10%. Payouts are quarterly and reasonably consistent. The first distribution was abnormally high because the fund launched in September 2022, so some of the September income was included in the fourth quarter distribution for that year. PBDC is a fund that is 100% focused on business development companies. These are private lenders that focus on lending to mid-sized businesses. The beauty of this sector is that it's designed to deliver most of its returns in the form of income. BDCs were established by Congress in 1980 to provide capital for small to medium-sized businesses. Their regulated investment company structure allows them to enjoy favorable tax treatment if they distribute at least 90% of their income to shareholders. So, from an investor's perspective, they're far more income-oriented than, say, a bank or any other financial services company. There are about 50 BDCs, and they're not all good performers. PBDC actively manages about half that number and weighs heavily towards its top 10 holdings. I like BDCs because the good ones have a long history of delivering consistent income through various interest rate cycles. When interest rates are rising, you'll hear some people say that it's bad for BDCs because the borrowers won't be able to cover their rising interest payments and they'll default on loans. When interest rates are falling, you'll hear some people say that that's bad for BDCs because lower interest rates means they can charge less for loans and they make less revenue. The reality is that a good BDC can navigate the pros and cons of all interest rate environments. For example, I've read some concerns that BDCs won't do well in a low interest rate environment. Well, obviously that's happened before. If we take the period 2010 to 2015, the Great Financial Crisis was over by then, and the Fed had not yet begun its hiking cycle that kicked off in 2016. Here's the total return for 3 BDCs during that period, 2010 to 2015, when the Fed funds rate was basically zero. Not all BDCs did well, but the good ones did. They were able to refinance into a lower cost of capital to deal with the lower interest payments they were receiving. Of course, there are other factors that affect returns like inflation, consumer confidence, the job market, etc. So I'm oversimplifying a bit, but the point is that low interest rates don't automatically crush BDCs. Last but not least is a fund of funds, CEFS, which yields about 8%. The regular distributions have been consistent, and sometimes it also pays special distributions, which is nice. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. CEFS is hard to beat for diversification. It holds about 100 closed-end funds, and some of those funds in turn hold hundreds or even thousands of investments. For example, here are the top 20 holdings for CEFS. Currently, the largest, ECAT, in turn holds over 1,400 equities, fixed income, and option positions. Then at number 2, there's ASA, which adds about 100 gold and other precious metal-related companies. Almost no yield for ASA, but the price is up by a staggering 102% over the past year. The third largest holding is GDV, with over 650 positions. The top 10 for that fund only has one Mag 7 holding, which is Microsoft. The other 9 diversify into garbage collection, tobacco, and financial services. The fourth largest holding, PDX, has a diversified portfolio of over 400 holdings, but its largest focus is midstream energy operators. These facilities get paid fees for storing, processing, and transporting oil and gas. I think that's enough for you to get the point about the diversification for this fund. Regarding strategy, CEFS buys closed-end funds at a discount, then sells them when the discount shrinks. They also take an active role in pressuring the funds they hold to offer attractive terms to their investors. For example, offering to buy back discounted shares at full price. This was addressed in more detail in this recent CEFS review update. So those are the 3 that I'd pick, but you could make an argument for other income investments. So let's take a quick look at some of them. Corporate bonds offer diversification and low volatility, but the yields and returns, not that compelling. LQD is a $30 billion investment-grade corporate bond fund, currently yielding 4.35%, and over the past 10 years, it has a total return of 34%. That's not really very good. Then there's high yield or junk bonds, which are supposed to be riskier than investment-grade bonds. The $18 billion HYG fund invests in high-yield bonds, yields 5.69%, and has delivered a total return of roughly double what is supposed to be the safer investment-grade bonds. The thing is, any decent BDC can beat that. BizD is a passive fund that simply tracks the MVIS US Business Development Index. Those aren't the best BDCs, it's just a broad index of 33 BDCs. It yields 11.79% and over the past 10 years has a total return of 156%. Much better. Some of the funds I hold, like PFN, include some corporate bonds, but it's not an asset class I'd want to be heavily reliant on. All right, let's pick up the pace. Utilities are somewhat recession-resistant, tariff-resistant, and they stand to benefit from AI driving up demand for electricity. But it is a narrow sector, so too much concentration risk to dominate a portfolio. Then there's Bitcoin, and it's been doing fantastically well over the long term and also over this past year. BTCI yields 28%, and here's the total return since it was launched in October 2024. But you don't get a 53% total return in less than a year without volatility kicking in at some point, which I'm sure it will in the future. We have to keep in mind that Bitcoin is always at risk of a massive crash. In 2022, we thought the S&P 500 falling 20% was bad, but Bitcoin fell more than 60%. As a retiree, I have to limit my exposure to that kind of volatility. Midstreams have had a fantastic run since 2020, but they're entirely dependent on the health of the oil and gas industries. Another example of concentration risk. For example, NML yields 8% and has been on an incredible run for the past 5 years. But 2014 to 2020 was a disaster for that sector. CLOs, or collateralized loan obligations, are good when interest rates are high, but they're built on variable rate loans. So the lower interest rates go, the less desirable they become. Looking back to 2020 and 2021, when the Fed funds rate was close to zero and CLO distributions were tiny compared to now. Preferred stocks are great because they're designed to deliver most of their returns in the form of income. However, not every company wants to issue them. They work particularly well as a way for companies to raise capital in the finance, real estate, and utility sectors. The heavy concentration on those sectors means not as much diversification as the 3 picks I gave earlier. Gold, very hot right now, but let's not forget that it can crash for decades. If you bought gold in 1980 and sat on it for 25 years, you lost money. I don't have that kind of time to wait for a recovery. US stocks have outperformed Europe and Asia over the long term, but that changed in 2025, as we can see here represented by IDVO. I like this fund a lot, but it only yields 5.2%. I'd like more funds like this, but it's challenging to find the kind of yields available in the United States. The search for those continues. Even though these other income investments didn't make my list of 3, they each have something valuable to offer. I hold them not because I think they'll necessarily increase my returns, but because I think they'll reduce the risk of disruption to my income stream. I never recommend copying my portfolio or anybody else's because we all have different needs and risk tolerances. But I hope that by sharing my reasoning, it helps you think through your own process for choosing which income investments to focus on more heavily. If you'd like to learn more about the 3 funds I featured, click here for a link to videos that focus on my top 10 holdings, including those 3. More Armchair Income coming soon.
Armchair!